By any conventional metric shown on your evening news, the United States is currently locked in an absurd diplomatic spat, a bizarre and almost comical attempt to purchase a massive frozen island in the Arctic. The media laughed at this. But there is nothing to laugh about here. Behind the closed doors of the sovereign risk departments in London and New York, analysts know that this is not a negotiation. It is the official protocol for a strategic demolition. You are not watching a real estate deal. You are watching the final hours of the post-WI dollarized alliance structure. While the public consumes the political theater, you are accessing the precise institutional modeling used to price the collapse of global risk. Let us call things by their proper names. Washington has just weaponized the single greatest asset. It has left access to the American consumer, and they are holding their own NATO allies hostage with 25% tariffs to coerce the annexation of hard territory. Now look at the map. Draw the trajectories. Greenland is not just ice. This is not real estate. This is physics. It is the geographic choke point controlling future Arctic shipping lanes and the direct flight path for intercontinental ballistics. Therefore, the NATO members currently guarding that ice are no longer allies. They are hostages of geography. The official narrative says this is about securing critical minerals for the green energy transition. No, wait, that is the illusion they feed to the public. The real calculus is much darker. This is about collateral. Washington is sacrificing the geopolitical trust of the last 80 years because the underlying financial system requires hard assets to survive what is coming. The catalyst date is set. The dominoes are already falling in the offshore bond markets. But to understand exactly how this transition is going to mathematically confiscate the wealth of the average household, we first have to deconstruct the lie they are currently selling to the panicked elites at Davos. Look at the headlines currently bleeding out of the World Economic Forum. The official narrative from Washington frames this unprecedented extortion as a noble crusade for global rebalancing. They claim that European allies have been freeloading off American defense subsidies and historically low tariffs for decades, while simultaneously allowing Chinese and Russian infrastructure to encroach upon the critical shipping lanes of the Arctic. And so Washington's public justification is that they must escalate to de-escalate, threatening the European export machine with crippling levies to force them to cede sovereign control over Greenland. On the other side of this theatrical ring, you have the European bureaucrats clutching their pearls and screaming about hostile economic coercion. Brussels is currently drafting what they term unprecedented countermeasures, threatening to target key American sectors, restrict defense contracts, and fundamentally decouple their supply chains from the dollar. The mainstream media dutifully reports this as a grand moral struggle between American protectionism and the European rules-based order, serving up convenient scapegoats for the public to hate. They blame the European pacifist who refuses to pay their fair share, or the Asian aggressor lurking in the northern ice. No, wait, those are just characters in a script. The actual scapegoat is the very concept of free trade itself. As anyone who has managed global risk portfolios knows, morality is a fiction written for the middle class. When politicians scream about fairness, you must immediately look at the money. Look at the Canadian and German finance ministers at Davos admitting that the structural speed and scale of these tariff threats are dismantling the global architecture overnight. This entire public debate is a masterclass in misdirection, designed to keep you fixated on the political soap opera, while the real institutional wealth transfer happens in the shadows. Because if Washington's goal was truly to secure the Arctic and protect American manufacturing jobs, as they so loudly claim, the underlying economic data would align with that strategy. But when you pull back the curtain and audit the raw mechanical numbers of the global trade system, the official narrative does not just fray, it mathematically collapses into a massive, terrifying contradiction. When I first ran the macroeconomic data from Davos against Washington's geopolitical claims, I genuinely thought our institutional models had pulled a corrupt data stream. I hesitated because the official story requires a suspension of basic logic so profound that you have to assume the strategists in the Pentagon are either utterly incompetent or they are lying to you about their true target. Let us look at the map again and examine the so-called Arctic security paradox. Washington claims it needs to seize Greenland to construct an impenetrable ice wall against Russian and Chinese expansion. Yet, the mechanism they are using to achieve this, brutalizing the economies of Norway, Denmark, and the United Kingdom with 25% tariffs, actively fractures the exact coalition that currently maintains the sonar nets, satellite uplinks, and air bases guarding that northern frontier. You do not secure a flank by executing the sentry, and you certainly do not invite Beijing into the Arctic by bankrupting the European deterrent. But the real deception, the part that exposes the systemic fragility of the American economy, is the re-industrialization fallacy. Politicians stand at podiums and claim these tariffs will resurrect the American working class and rebuild the industrial base. No, wait, that is mathematically impossible based on physical input costs. If you look at the raw data for steel, aluminum, and intermediate components, tariffs are the exact catalyst destroying the American industrial base. The closely watched manufacturing index data out of Davos shows United States manufacturing has contracted for the 10th consecutive month, precisely because the tariffs meant to protect these factories have choked their supply chains to death with structural inflation. The politicians know this data, and the central bankers definitely know this data. This leaves us with a singular, uncomfortable deduction. If the tariffs actively sabotage the geopolitical map, and they demonstrably contract the very manufacturing base they claim to protect, then the official justification is a total fabrication. There is a hidden variable driving this systemic shock, a motive so cynically calculated that Washington is willing to burn the entire post-war alliance structure to the ground to achieve it. And to expose what that ultimate motive is, you have to ignore the news entirely and look at an obscure chart from 971 that tracks what the central banks do in the dark right before a currency regime dies. To understand the sheer magnitude of the deception currently playing out on the geopolitical stage, we must completely discard the comforting illusion of American economic dominance and look instead at the terminal mathematics of the sovereign debt market. The mainstream media wants you to believe that Washington is playing a grand, aggressive game of chess from a position of unrivaled strength. But if you look at the raw flow of institutional capital moving in the shadows, you will realize that Washington is not expanding its empire at all. It is executing a controlled demolition of it. Here is the part they are not telling you. The unifying thesis of this entire geopolitical event is brutally simple, yet so catastrophic that no elected official will ever state it out loud. The American sovereign debt model, the very engine of the post-war global system, is mathematically terminal. Washington knows that the era of exporting inflation to the rest of the world via dollar hegemony is over, and so they are deliberately blowing up the global alliance structure to force capital back into a protected autarky before the bond market collapses. This is not a political choice. This is a physical necessity. An empire built on infinite paper leverage cannot survive the physical constraints of the 21st century without locking down the literal bedrock of future technologies. The artificial intelligence sector alone requires gigawatts of new energy infrastructure, and the military-industrial complex requires unrestricted access to rare earth minerals. By weaponizing the consumer market to seize Greenland, the United States is linking monetary policy directly to geography. They are transitioning from a system based on global financial trust to a system based on exclusive physical control. If you doubt that a superpower would willingly sabotage its own allies just to survive a fiscal crisis, you only need to look at the exact historical blueprint for this operation, because we have seen this exact mechanical sequence before. Go back to August of 1971, to the Nixon shock. The United States was functionally bankrupt, bleeding gold reserves to European allies who were calling Washington on the bluff of the dollar. So what did the Americans do? They unilaterally severed the dollar link to gold, effectively defaulting on their international obligations. And they masked this financial capitulation by slamming the closest allies with a sudden 10% tariff surcharge. The political excuse back then was protecting the American worker and ensuring exchange rate stability. No, wait, that was just the public relations script for the masses. The mechanical truth was that the system was dead and Washington was forcing its allies to absorb the shockwave of its own fiscal irresponsibility. Today, the playbook is identical, but the stakes are exponentially higher. Look at the balance sheets of global central banks right now. Institutional gold purchases have surged to levels not seen since 1967, which was the immediate run-up to the 1971 collapse of the gold standard. Smart money is already front-running the death of the dollarized trade order. By linking these century-high tariff threats directly to the acquisition of Greenland, Washington is signaling to that smart money that they are trading the illusion of paper hegemony for the reality of hard, commodity-rich territory. It is the ultimate geographic hedge. You cannot print rare earth minerals, and you cannot monetize an ice sheet. And who benefits from this transition? Who is the true beneficiary behind the smokescreen of political chaos? It is certainly not the average citizen who is about to be crushed under the weight of imported inflation. The real beneficiaries are the institutional capital allocators, the sovereign wealth funds, and the hard asset monopolies. While you are watching the Davos melodrama, the smartest money in the world is actively front-running the inevitable, debasement of the currency by pivoting aggressively out of paper debt and into gold, critical minerals, and closed-loop supply chains. This is why, buried deep in recent Commerce Department filings, you see a quiet carve-out allowing American artificial intelligence chip monopolies to maintain a highly regulated backdoor into the Chinese market, even as the tariff walls go up everywhere else. National security is the narrative for the masses, but the preservation of vital tech monopolies is the reality for the elites. The system is not preparing for a trade war. It is preparing for the death of the dollarized trade order. But this managed retreat into a resource-backed fortress relies on one critical, arrogant assumption by the central planners. They assume they can bully Europe and Asia into submission without triggering a counterattack on the one market that keeps the American government alive. And that is the exact point where the architects of this collapse have miscalculated, because the opposition is not going to retaliate with empty political speeches. They are about to attack the very heart of the financial system, initiating a chain reaction so violent that it will take less than 72 hours to break the world. To understand how a political tantrum over an Arctic ice sheet triggers a global financial collapse, you must ruthlessly isolate the variables. You must ignore the 99% of economic data that the media feeds you, the daily stock market fluctuations, the unemployment reports, the political polling, and focus entirely on the one singular metric that holds the entire American empire together. Forget the Dow Jones. Forget the trade deficit. The fate of the post-war system hinges exclusively on the 10-year United States Treasury Yield, which is the global cost of borrowing in the world reserve currency. It is the fundamental heartbeat of the global financial architecture, and right now, that architecture is experiencing cardiac arrest. Let us calculate the physics of the fallout, because this is a mechanical chain reaction, not a political one. The entropy cascade begins the moment these 25% tariffs are executed. Physical supply chains do not adjust instantly to political whims. They are massive, moving systems of steel, fuel, and time. Tariffs fundamentally sever transatlantic shipping routes and drive up the cost of raw inputs, insurance premiums, and maritime logistics to such an extreme degree that baseline inflation is cemented permanently into the Western economy. But this first-order effect is merely the appetizer. It is the obvious, boring consequence that any undergraduate economics student could predict, and it is here where the arrogance of the Washington strategists blinds them to the catastrophic second-order reaction they could have just unleashed. Because when you hold the economies of Berlin, London, and Tokyo hostage, the opposition does not retaliate by simply taxing American whiskey and motorcycles. No, wait. That is the pathetic theatrical response the politicians are expecting, the stuff they write about in the Financial Times. The real institutional response is far more lethal and invisible. They retaliate financially by executing a silent liquidity strike against the American government itself. For decades, the European and Asian central banks, along with allied sovereign wealth funds, have acted as the indispensable buyers of last resort for American debt. They have dutifully recycled their dollar surpluses back into Washington to finance the American deficit, functioning as the geopolitical glue of the alliance. But once the American consumer market is weaponized against them, once access to that market becomes contingent on ceding sovereignty over critical geography like Greenland, that symbiotic trust is irrevocably broken. These foreign capitals do not make grand announcements. They simply and quietly cease their bids at the Treasury auctions. This signals a complete systemic non-compliance that vaporizes the primary base of dollar recycling liquidity. The math of this is brutal and instantaneous. Without foreign buyers to absorb the trillions of dollars in newly issued American debt, the price of those bonds collapses, and as bond prices collapse, the yields violently explode upward. We are now crossing the event horizon into the third-order effect, the ultimate systemic climax, where a 10-year yield spiking uncontrollably past 5.5% triggers a total Treasury market failure. It is almost insulting how predictable this is. Once again, the central planners are trying to put out a roaring structural forest fire with a water pistol of debt, completely ignoring the fact that the cost of servicing the $34 trillion national debt at these elevated rates instantly eclipses the entire defense budget and total tax receipts combined. This is the fiscal death spiral. This is the exact moment where the Federal Reserve realizes the Treasury market is frozen, and the government is functionally insolvent, forcing them into the absolute worst-case scenario. That scenario is emergency yield curve control. Yield curve control is the official term for monetary capitulation. It is the final, desperate act of a dying empire, where the central bank explicitly caps interest rates by printing trillions of dollars from absolutely nothing to buy the toxic debt that Europe and Asia are now dumping onto the open market. This is the hyper-financialized equivalent of eating your own seed corn by monetizing the national debt to save the bond market. The Federal Reserve deliberately triggers a catastrophic currency debasement. They destroy the very dollar leverage Washington tried to weaponize in the first place. The dollar is no longer a tool of hegemony. It becomes a localized, rapidly devaluing asset, forcing the rest of the world to immediately settle global trade in a non-dollarized commodity-backed financial infrastructure. The global standard of living is reset in an instant. The American consumer is left holding the bag of a bankrupt empire. But the true horror of this event is not what happens to the global order in the history books. The true horror is how this exact macroeconomic failure is going to surgically dismantle the safety of your personal life, effectively vaporizing everything you have worked for by the end of next quarter. I need you to step away from the abstract geopolitical chessboard for a moment. The destruction of the American risk premium and the Federal Reserve capitulation to yield curve control is not a theoretical problem for economists. It is a direct mathematical confiscation of your personal wealth. While you are sitting there watching the news treat this Greenland tariff situation like a spectator sport, the mechanical forces I just outlined are actively pre-positioning the financial system to use your life savings as the final buffer against sovereign default. You see, the 10-year Treasury yield is not just a government metric. It is the fundamental anchor rate that prices the cost of your existence. When that yield spikes past 5.5% because the European and Asian central banks refuse to fund our deficits, it drives the baseline for every credit card, auto loan, and no wait, that does not capture the true violence of the credit spread. When the sovereign yield goes to 5.5%, the 30-year fixed mortgage rate does not just tick up. It instantly gaps up to over 10 or 11%, effectively freezing the entire real estate market overnight and trapping millions of middle-class families in underwater assets they can neither afford to maintain nor manage to sell. Fast forward to the third quarter of 2026, you are standing at the gas pump or walking down the grocery aisle, realizing that the decision to print trillions of dollars from nothing to buy up dumped debt has fundamentally vaporized the purchasing power of the consumer, because the United States does not manufacture the goods it consumes, but rather imports them. The collapsing value of the dollar means the cost of every smartphone, every gallon of fuel, and every imported calorie goes vertical. This is not inflation driven by demand. This is structural hyperinflation driven by the collapse of trust in the currency itself. This is how the system quietly steals your future. The government will never directly tax your retirement account, as that would trigger a political revolt. Instead, They will simply debase the currency it is denominated in, allowing your pension to grow nominally while its actual purchasing power is cut in half. You are not witnessing a trade negotiation. You are witnessing the silent, deliberate liquidation of the middle class to bail out a bankrupt sovereign bond market, and the terrifying reality is that this cascade is no longer preventable by any elected official in Washington. But the real question you should be asking yourself as the dollarized world fractures is not if this happens, but what the new financial physics of the incoming multipolar world will actually look like for those who refuse to be. Collateral damage, because the final transition is going to be far more permanent than anything we have seen in the last 80 years. In the end, the history of global finance is not written by the moral high ground, nor is it shaped by the desperate, sweating speeches made at Davos. It is written by the brutal physics of currency regimes. This physics dictates that while paper hegemony is strictly temporary, hard territory and critical commodities are absolute. By holding the European trade system hostage for a frozen piece of Arctic real estate, the United States is officially conceding the game. They are publicly trading the decaying illusion of fiscal dominance for the permanence of geographic and mineral security before the monetary music stops. The politicians in Washington still believe they can navigate this transition through clever statecraft. No, wait, that is pure vanity, because you cannot negotiate with the laws of mathematical physics. Once the debt outgrows the physical capacity of the productive economy, the currency must absorb the default. Look at the national debt clock. It is not a financial ledger anymore. It is a countdown timer to a new multipolar reality. Nobody, not the Federal Reserve, not the European Central Bank, and certainly not the talking heads on financial television, knows the exact date when the dam will finally break. Human panic cannot be perfectly timed, but the trajectory is now set in absolute stone. The age of unbacked financial leverage is closing, and the transition into a resource-backed autarky will be utterly ruthless to those who refuse to see the mechanics in motion. So, as the headlines continue to scream about the political theater of Greenland, ignore the noise and watch the only metric that matters anymore, which is the United States 10-year Treasury yield. Because the moment that line breaches the threshold and breaks the Federal Reserve, what exactly is your plan to survive the aftermath?